And I think that's probably what's going to happen, is that silver's going to vastly outperform gold in the coming months. Well, that's normally been the case, actually, in the past. Even during crash events, there's one instance that everybody remembers that was in October of 2008. Stock market had already been going down big time for over a year at that point in time. Gold had been going up for a couple of years, since 2000 through 2008, and was somewhat overbought then. And so when the stock market finally did have a crash event in a year off of its high in that 2008-9 bear, gold joined in. It joined in for all of about 4 to 6 weeks, where they're going the same way. They weren't going the same way before. And then shortly after that event, stock market continued on down through the first quarter of 2009. Gold was back at its highs by early 2009. So they diverged. But there was that brief instance, and everybody remembers that, at least if you're around then. But if you go back through history and look at even crash events, like I happened to catch the crash in '87 before I set up MSA. I didn't catch it a big way, but I caught it to where it smacked me in the face with realization that, hey, we can measure some of these things, okay? At that point in time, gold went up 9% that was a week or two of that crash. Why? I guess nobody told gold was supposed to go down, when the S&P crashed. But no, it went up anyway. And during the 29 to 32 great bear market, there was no gold futures or freely traded gold then, but Homestake Mining, the biggest gold miner in the world then, had a massive bull market during that huge bear market. Okay, so opposite the stock market. So the attempt to link gold to stocks as a fear element. Yeah, pay attention to it. Yes, if gold were excessively overbought at that point in time, when the stock market decides to really have a puke, then maybe gold will participate to some extent to clean itself up some, or not. So don't think it is a rule carved in gold stone that it must follow the stock market. It certainly doesn't. Okay. Anyway, in the 2007 to 2009 bear trend, the stock market down the whole year and a half period, T-bonds and gold went up. From 2000 to 2002 bear market, gold went up, T-bonds went up. Okay. So here we are. I think we're topping out the stock market. Yes, we've taken out the 2022 price highs by about 10% or so. In some indices, some haven't even reached it. And if we roll over here, we think there's triggering factors in the S&P 500 and the NASDAQ 100 that will be engaged in the next quarter. If you merely ooze back down about 5% below where you're trading right now, those indices can't sneeze between now. So if September, for example, unfolds as a wobbly month, and we ooze back down several percent, you'll be in a position via our momentum metrics to trigger a structure, break a structure of support level that suggests you could open the Bombay door. Now, it doesn't have to be a crash, but it's likely to be a very sharp onset of major decline. And I think that the Federal Reserve and the monetary factors around the world will increase dramatically liquidity, artificially low rates. It's all the things they do, and that will benefit gold. So anyway, but we do see the stock market being in a very vulnerable position to where September better not be a wobbly, non-headline, but just wobbly a bit, pull back 3, 4, 5%, because you'll be in a position then to trigger certain momentum factors that say, gone. You'll go down. Anyway, so that's what we see in the stock market. And I think it's likely that those trigger levels will be engaged in the next month, after September. Well, if you go back and look at 2001, in January of 2001, about 4 or 5 months off the high, not far off the price high back then, the Fed cut rates twice that month. Somewhat surprised the market, okay? They cut rates for the next 2 years. It didn't do a bit of good. Stock market collapsed. In fact, when they started cutting rates, if you circled where the S&P was and went short then, it did great, okay? In 2007, 1 month before the high, in fact, about 3 weeks before the traded price high, which occurred in October 2007, The Fed in September 17th, 2007, cut rates by a half a basis point, and it was shocking. Nobody expected it. The comments from Wall Street were, "Oh, Christmas time party," et cetera, et cetera. It was a guy getting a present you didn't expect, and all these kind of comments. I went back and I looked through the newspaper archives to see what the Wall Street reaction was. It was total shock. They did not expect it. So the market rallied, priced in the rate cut. Rallied for about 3 weeks. That was it. It was all over when we started to collapse. And they cut rates all the way down, and yet the market went down. Okay. And gold went up, and silver and the T-bonds went up all during that time, except for that October event in 2008. This time, it's fully anticipated. There's no surprise about a rate cut. In fact, they told us, Powell effectively said so about the second week of July when he was testifying, that no, their focus now is, they want to get down to 2% rate, inflation rate, but they thought they were on target. And they were now focused on their other mandate, which is economic disturbances, unemployment, et cetera, et cetera. And he says, I don't want to wait for data points to demonstrate that we've made a mistake by staying too high, too long. Meaning he's not even waiting for the data points, he said. So that's a hell of a statement, okay? And yet the market, it dropped a little bit and then it exploded over the last month or two off the July low. The S&P rallied back to its high, and it's probably when they open tomorrow, I bet they nip out the high that was made prior to that. They're just short of it right now. Just to nip out the high so they have a headline. And of course, the market has already priced in the rate cut that's likely to occur in mid-September. So it's not a surprise this time. So once they cut the rates, if you buy then, you're sort of late, aren't you? They already told you they were. And we're suspecting you're getting the rate cut rally right now. And by the time they cut rates, whether it's 25 or half a point, I suspect it's going to be half, but we'll see. The market will, not know what to do and start to roll over. And that's when you get your real pain, is if we get a wobble in September, it puts us in position to trigger stuff in October. Meanwhile, gold has been congested. It ran up to 2450 back in April. Right now, we're only $60 above there right now, 25.10, okay, the front month contract. So gold hasn't really been hot over the since April, May, June, July, now August, September. Okay, so 6 months, gold's been steady, mostly sideways, and only recently last month got up above the 2,500 mark. So it's not exactly hot and overdone. It's not like it's been going up vertically for the last 6 months. It's paused. And I think it's ripe now to engage in a more accelerated upside manner. And we've got some trigger levels that we specify in the weekend report to our subscribers that tell us that this arm wrestling pause that we've had ever since the acceleration surge between March and the April-May high. For silver, it was a May high, much higher than it was in April, whereas gold paused after the April high. Silver went on. But they both have congested and gone into a confusing price chart action, which people think, oh my, it's topping out, or they don't know what's going on. We think it's merely cooling off after a very rapid price surge. And they're now cooled off and ripe to go up again. So I think that's the position of those two core markets. It's basically opposite. In fact, in the weekend report, we showed that since you go back to January this year and plot a gold monthly momentum chart and an S&P monthly momentum chart, they pivoted exactly at opposite months. S&P makes a high, gold makes a low. Gold makes a high, S&P makes a low. Exact same months. So they're total opposites right now. But anyway, I think that's what's setting up, is that there's a level of, like, we got up to 25.45 on the nearby gold recently, last month. You get back up there again, you're going to engage more strongly. Silver is coiled right now between about 29 and 30. Now remember, it made a low in August in the pullback. No, excuse me, in August at 26.50. So we're well off that low. They ran a bunch of sell stops and cleaned it out and then popped back up. You get back over 30 again, which isn't to say anything great because our highs recently have been 32 plus. Okay, so but you get back over 30 and silver is going to re-engage out of this congestive confusion. So gold and silver are poised to reignite. Anyway, it's going to be interesting. We can't put a price level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to $850, okay? Or from 2000 lows of about $265 gold, and you went to 1920 by 2011 over the next 10 years or so, okay? That's an 8-fold move. Well, we started from a bare low at 1,050. You do the math. Yeah, we're double and a half. Okay, so no comparison in terms of how much multiple gain has gold had so far in this, 9-year-old bull market. So if you use those old metrics and say, well, we can do what we did then, sure you can. The fundamentals are even more dramatic now. Gosh, you can have $8,000 gold. Now, that's not a target. It's just noting past history. And we also note that back in those periods, when you in those bull surges, and by the way, I'd comment on that, maybe have an after comment on this. When you ended those bull surges, that last several quarters of the bull market, you went parabolic. Gold went up hundreds of dollars. Silver went from, like you said, 20 to 50 in a matter of, several months. The same was true in 79 to 80. It's also true in mid-2010 through April 2011 for silver. You went absolutely off the page. Right now, silver's, well below those price highs, $50. Why is so? Gold's above those comparable highs. Even copper recently traded over $5, taking out its 2011 high and its 2020 high. And yet silver's still, $30, let's say, it's $20 short of its peaks. Do you think he can't get there and maybe go past it? Well, be reasonable. Maybe silver's just lagged for certain reasons, and once markets like that get shocked into a new reality, they tend to go berserk. And I think that's probably what's going to happen, is that silver's going to vastly outperform gold in the coming months.